Hey, good morning, everyone. Marty Mazzori here, March 15th, 2023, Wednesday. This will serve both as your midweek stock market snapshot as well as just the morning message. I was going to write to you this morning about copper, but given the market events, I thought I'd let the open come in, let the market settle down a little bit, and then just talk to you here about the market and show you a few things that we're looking at, and of course do the technical snapshot for stocks. So as I speak to you, S&P's down about 1.5%, NASDAQ's down about 1%. Our core portfolio, the things that should be holding up today under the circumstances and based on what we think the market is trading on, holding up pretty nicely. Treasuries, long-term treasuries are up about 3%. That's a position we've added to lately, as are intermediate treasuries, 1.6%, another position we've added to lately. Gold's up over 1%. Silver's up almost 2%. We also have added to consumer staples. They're down 1/3%. But again, as I told you, the market's down a lot more than that. We've added to healthcare. That's down 0.8%. Again, market's down quite a bit more than that. Our put options, of course, are having quite the day this morning. Although we're still ways out of the money. And so the clients, as you've experienced, those, help a lot if the kind of downside volatility we've had of some days of late amount to something breaking. Clients in our review meetings, I think I keep telling all of you, or I've been telling all of you since January, that nice run-up we had, don't spend the money just yet. Our base view is that the market probably has lower to go, even lower than that 3,500 here that you see on the chart before it's all said and done. So since I have this chart up, I'll go ahead and just quickly look at the technical setup. Then we'll look at some other things together that we're keeping a close eye on. So this is your one-year daily chart. And folks, as I said to you, nothing worse than a failed breakout. We've had this real nice inverse head and shoulders that looked really, really good. Came back, tested it. Remember, I said that looked very bullish. But our base case, because of lots of other factors, is that it'll ultimately be a failed pattern. Right now, that looks to be the case. In fact, losing all of the major moving averages. You notice the 20-day moving average is really rolling over. The market broke down below the 200 and the bear market trend line, retested it a couple times, and is failing it miserably today. These are all really bearish signals. Remember I said I think there's probably major support at 3,800. You can see we didn't quite get there on Monday, bounced off of that, but then lost it here on the bear market trend line. I still think that 3,800 support could be pretty strong. According to our options experts, that put wall that I explained how that worked last week has been moved down to 3,800. So remember, those dynamics mean that there could be some pretty good support there. Big options expiration day this Friday. There's a lot of puts expiring that could lead to more upside pressure into the end of the month. But you've got so much going on. You've got news around Credit Suisse this morning that's really causing consternation really across the globe, particularly in the banking sector. Just essentially the result of years and years and years of central banks, I think, doing the wrong thing and skipping every opportunity to allow rates to rise with economic conditions. And then ultimately, when that inevitable happens and you have to raise rates in a hurry, things begin to break because the world has established itself in a regime that appears that they're never going to let interest rates rise. Well, economic factors ultimately come into play. We have a long-term thesis that says inflation is going to be structurally higher for a long time. It demands a whole different setup with regard to fixed income. So there's that, and then there's just the recessionary risk. Remember I said the other day that, ultimately, if we're right about the next leg down, it's actually going to happen amid the Fed cutting rates. And I'm going to show you a little bit of historical evidence that supports that idea. So anyway, so here we are, folks. Expect the market potentially, if it gets to 3,800, the bulls out there are going to get real excited if and when we bounce off of that. So that remains to be seen. I think I'll just move on from the technicals. the 2-year Treasury yield versus the Fed funds rate. So the 2-year Treasury is considered an indicator of probabilities for Fed funds rates. And it's pretty good, right? Here we go back to 2016. You see the 2-year yield begin to rise before the Fed started hiking. This is these, look like quarter point increases through that 2016 to 2018 period. And then you see it begin to roll over, right, months before the Fed started to cut interest rates. Now, the stock market took a 20% hit in the fourth quarter of 2018, and that inspired the Fed to stop its quantitative tightening and then ultimately to reduce interest rates. Here we are in 2021, right? There goes the 2-year yield, and there goes Fed funds. Now, remember, what did I say? I'll say it again. Ultimately, in a recession, second leg down for the bear market scenario, the Fed is cutting rates while the stock market's falling. They're trying to catch a falling knife, essentially the recessionary economy. Now, look at the 2-year Treasury yield falling like a rock, right? And we still have a Fed that is scheduled to raise interest rates next week. We'll see if all this doesn't inspire a halt, as some people are predicting. We're still in that 25 basis point camp because we still have inflation. Ironically, this morning, the producer price index came out. It was down month over month, and stocks did not rally, folks, again. So this is telling us that the setup for that final leg down may be actually, showing up right in front of us right here in real time. Still would not surprise me to see this market bounce off of that 3,800 level, and again, off of perhaps dovish talk tomorrow from the European Central Bank, and then, of course, next week from the Fed. Okay, all that remains to be seen, but this is not a great environment for the bulls, to put it mildly. So this is the Fed funds rates futures giving us expectations. So this is as of February 15th. You can see we anticipated high odds of further hikes. Ultimately, later in the year, here's November, December, and January, discounting the beginning of rate cuts, or at least rising odds of rate cuts. Now, when the Fed would give us any hint that they may be softening, well, then stocks would rally. But remember what I said. I think the market may be right that the Fed will be cutting later this year. But if they are, it's because we are in recession, and that's probably not a good sign for stocks. We do think that stocks could very, very well bottom before the end of the year, and we could actually have a net positive year, but we think it gets worse before it gets better. Could be wrong. That's just our base case right now. So look how quickly things change. Here we are a month later, and the odds have dropped in half at this point for next week. And then here we are in June with prospects for rate cuts. And the market is falling out of bed. Let me repeat for like the third time this morning. It's because now the stock market is anticipating what comes with recessions, and that is lower corporate earnings. The MOVE Index, I featured this a couple weeks ago, and I said, this has been maybe even more telling than the VIX. It's the VIX for Treasury bonds, measures implied vol on Treasury bond options, and this is the one I presented on the written blog, and I showed. When you get an elevated MOVE Index, it denotes risk in the fixed income markets. And here we are looking at like 2008 scenario now. We do not have a 2008 credit market. I can say that with 100% confidence. But we have fear of something breaking. And the stock market action here isn't yet reflecting what we're seeing in the MOVE Index. Doesn't mean the market's going to come crashing down, but it certainly says the risk is there. Another one would be credit default swap spreads. And this is on investment-grade U.S. corporate bonds. So this is essentially insurance against bond defaults. So this rises when there's legitimate recession risk out there. And, of course, if there's recession and corporate earnings begin to drop, well, the chances of bond defaults increase. High-yield spread. These are inputs to our financial stress index. Again, historically, this isn't necessarily where things totally break, but again, elevated, right? Increasing risk in the credit markets. And then lastly, just to give you the optics on that point I made about the stock market can indeed drop when the Fed is cutting rates. Well, these red shaded areas are recession. This is a chart I worked up a long time ago, so I'm just going to leave these annotations on there. It shows these drops. But here's the second of the back-to-back recession in the 80s. This is the Fed funds rate dropping, and this is the stock market dropping. Fed funds rate being cut. Stocks continue to fall out of bed. The great financial crisis, right? So again, during recessions, when the Fed is reacting finally, stocks still continue to fall. And that's that second leg down scenario we've been talking about for the last couple of years. And then what makes this more challenging is that we have real world inflation on top of that. We didn't really have that to the extent that we have it here. So we have a Fed that's like, oh my gosh, we have to kill inflation. But now we have recession risk. We don't want stagflation. It makes for a very confused backdrop. What's the Fed going to do next week? Are they going to pivot like they did in 2018? Well, in 2018, they didn't have the kind of inflation pressures that they do right now. So I think, over the weekend, what did the powers that be do? They guaranteed all the deposits of the two banks that they closed down. What they're trying to tell the markets is, look, we are there to stem anything systemic in the credit markets, which in theory would allow them to continue to be aggressive with regard to inflation. If Powell sounds at all hawkish on even a 25 basis point increase next week, that's going to really play hell with markets. He has been very friendly to financial markets. He clearly gets rattled more than other Fed members, I would say, or more than many of them. And so, if we're continuing to suffer come Fed meeting next week, it doesn't mean they're not going to go a quarter point, but he's going to come in pretty dovish. So, folks, we're going to continue to manage our core portfolio as we are. We want to be in a position to do well like we did in January in an up market, but we also want to mitigate as much as we can, of what we still think is the second leg down in the market. And then, as I've said over and over again, I am bullish in a not small way in many things over the long term. One of those I was going to write about this morning, and that's base metals. Probably do that tomorrow. Now, lastly, tomorrow is the last you're going to hear from me until probably midweek next week. Clients, we take the family on a ski trip once a year. We did put the weekend right in the middle of that, but Nick and I and Ryan will be away from the office Friday until next Wednesday. Of course, the staff will be around if you need them, and we're not going to be where we won't have a signal. So I certainly could blog while on vacation, done it a million times in the past. Probably try not to, but certainly will if conditions call for it. I'll leave it there, folks. I will have a morning note for you tomorrow. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.